who sees that speed of execution and speed of learning, how you do this as a founder is three things. First, what VCs look is how you transmit your speed of execution in how you pitch, how you behave. The only thing you can do as a founder is train pitching to be just like better at pitching, but it's not really applicable. The second is to show a growth in metrics, and the growth in metrics is more important than your current revenue. That's the most important thing. And the third one is to pitch to investor your timeline of the past. Because the timeline of the past is a lot of times a metric that I see 80% of the founders forgetting in the first round, is that you show a timeline that, okay, I execute, I started working on it in January, I beat my MVP in 3 months, and then I shipped, and we see in the timeline of the past that you're executing quickly, and we can compare to other companies when we see that, for instance, it took them 6 months to do an MVP, for instance.
That's
I don't know if
super
I'm clear on that, but that's why personally I give very, very bad feedbacks to entrepreneurs, and I know this, and I told this at podcast, just because as a founder I was sent in a lot of very bad ways because VCs told me you should do this, so I did this, and it was a shitty idea. And so the thing is that I don't want to give bad pass to entrepreneurs, so I stopped it. But I know it's bad, but.
So thank you. So I'm not an investor, but at SeedLegals I talk to many, many founders. And in a sense, we follow founders on their journey because we might talk to them at the beginning when they do their first seed fast or come onto the platform. And then we see as they do a funding round or not do a funding round, and then the next round. And so you also pick up a pattern. And to me, were I to be a VC, I think you should imagine yourself as the investor and you coming to yourself with a pitch. And I think if somebody comes to you with a strong idea that they're really enthusiastic about, but they also show you the path to execution, this is the key. So if you go to a VC and you're not really clear on what it is that you want to do, if it looks like it's still a hobby and you're still noodling about it, it could be a B2C, it could be a B2B, the VC is seeing many, many people, and the ones that just stand out as being exceptional are going to be the ones that they might invest in. And that could sometimes be an exceptional idea, but generally in the early stages, it's the exceptional founder. And I think when you find somebody super driven on a call about fixated, we're going to change X and we're going to grow and we're going to do this, and you want to be part of the journey. So you want to convey that. Now, of course, sometimes it crosses over to somebody's drunk too much of their own Kool-Aid, if you know the expression, often an American, and they're so convinced that their blockchain island something will be the future of humanity that they become unbelievable and uninvestable. But for the most part, if you can show exactly as been shown here, you've got a strong idea, these are the steps we're going to take to execute, and this is the traction so far. Now, the problem, of course, is with the traction, if you have thousands of customers, and you can show last month I had 1,000, this month I've got 1,200, whatever it is. But if you've built nothing, then the question is, what can you show with traction? So investors are always looking to see that things are moving along and they want to get on that. And one of the things for things moving along is as they move, the valuation goes up, and that's of interest to the investor. So you know the term, fake it till you make it. Well, how can you pick the best set of metrics? And so here's my take, which is if you've got revenue, show revenue as a metric. If you don't yet have revenue, but you have users, show the number of users as a metric. If you don't yet have users, show the retention from the few users. Last time they stayed for 5 minutes, and now they're staying for 10 minutes, and they're going to stay for 15 minutes, and they're going to tell their friends. If you don't yet have that, you might show prototype testing where people showed results. Or if you've got a business-to-business B2B proposition, if you can show signed partnerships, that's fantastic. If you can't, show intended partnerships, but show that they are still in discussion. Otherwise, if the VC asks, have you signed that? You go, no, then it loses credibility. So at each point, you want to show that you're focused on achieving something and getting there, and then you're creating the time imperative as well. I think there's one other thing, which is with VCs, is you think VCs are the big risk takers. Yeah, we're going to go in. Often you find that they're actually very risk averse and they want someone else to come in first and only then they'll come along. And that's they say that I love what you're doing. When you've got a lead investor, call me. But this is a catch-22 for you because you're going to wait forever to find who's the lead investor. And here I think the BSAR is your friend, because with a funding round, you say to the investors, I'm raising €500,000. They're going to wait for somebody else to come up with the first 100,000 before they come along. But with BSAR, you're raising small amounts from individual investors, and you have a much greater chance of persuading someone to make that first investment. And then once you've got the first investment, you've now got some money that you can use to hire your designer or your web developer to get some traction. And then you can also, when you find your lead investor later, you can show you've already had some investment, so they're not the first. So just before I hand over to you, so to go back to when the investor says, love what you're doing, come back later. This usually means, I don't understand what you do, so I've no idea, but when other people understand it, then call me. It could mean that I understand it, but I've no idea if it's a good idea or not. I just can't make up my mind. So when it's been validated that it's a good idea, call me. It could also mean that as a VC raises a big fund, 100 million euros, which they then want to spend in a year or whatever, and they can't, very few investors can do like 2 a week. Mostly they'll have a committee and they'll decide and they'll do 1 a month. And that means each investment needs to be some millions of euros. But that means you really are too early, because you can't raise 1 million unless your valuation is maybe 5 million. And you're not having a 5 million valuation when you've just got a prototype. So you may literally be too early for a VC. And then you want to go and find angel investors, people who invest early or super early stage VCs.
That was my point, because you mentioned VC, but there is different, because what we see also at SeedLegals with the company we support and we help is that usually they go first with that first network. First network is what? Is friends, family. This is why we call it like friends and family. And usually friends and family are more keen like to invest with the BSAR because they, okay, I just follow you, I believe in you, I'm more like investing in the company, but because I believe in you, rather than just, okay, I'm looking to do like ROI or like to get some money out of this investment. So this is why what we see is that we have the first like individual investors, as you mentioned, Anthony, and then after you like have some growth, you can see some metrics and so on, because you have the first like gas and fuel on the and get the traction. So you can then go to a VC. But my first question would be, okay, how first you convince maybe not your friends and family, but maybe business angels, and then how you convince also VC. So first maybe with the business angels. How you can convince them, how you can find the business angels, what would be the best advice you can give to the audience? I'm kidding, but it's just like how to convince and how to find your investors first with business angels, and then it will be the same question for professional investors like VC, because there is a difference between the two, of course.
For business angels, it's a super good question. It's a super tough question.
Sorry for that, but
no, but like, to be honest, the 3 ways we advise people to how to find business angels is that first you have LinkedIn, and you can find, like for instance, if you're working in a specific vertical, in a specific sector, you can more or less find a proto persona of someone in an organization that might have some money because they are a VP of a specific company and stuff like this. You can always try to target them on LinkedIn. Yeah, and
it's a good one. It's also what we advise, like when we have a company with report, okay, how can I find investors with business angels? It's exactly that. We have like the chance to have like LinkedIn, and as you said, with like your industry. So of course, if you have like VP with high growth companies, of course their salary can maybe allow them to invest in companies, and usually they're keen to do so because they are like linked to the ecosystem, so they know how it works. They are part of high growth companies, so as you said, that's a really good
and it can be, for instance, for if you're working in the music industry, it can be someone from like Universal or someone that know the sector you're addressing, because the thing with this is that they need to create a conviction on the market, but the business angel works in this market. So they know this market, they know the inside out, and they will understand this problem. And sometimes it's a good way for you even to get clients and stuff like this, or to get industry knowledge. That's the first part. The second part is that you have super angels right now in Paris and in every geographies actually. And this is the business angel that you can find, like you see on press releases of funding rounds. They are in everywhere. It sometimes can be a good idea to enter, because all these business angels, they talk with each other. They have WhatsApp groups. They discuss with each other. At the moment you start to convince one, you will get the others. And the third one is business angel groups. You have like sometimes business angel networks. So some are better than the others, and you can use the network of Station F in order to know who are the best angel networks or not, because the level varies a lot. And that's the free sources that we saw a lot. I don't know for you.
Do you see other ways to get some business angels?
Sure. So I think the story goes something like this. You start your startup and now you're looking for investment, but you don't know any investors. I mean, where do you find investors? So you do some research and you find VCs, because they've got websites, their directories, you can look them up, you can look outside. And so you go off and get some meetings, or try to get some meetings with VCs. And you tell them, I'm looking to raise €500,000, whatever it is. And they go, love what you're doing, come back later. Because they always say that. And
not you, Alexis, of course. Sometimes.
And then you realize you're just far too early to go to a VC. And now you need a plan B. And the plan B is angel investors. But the problem is you can't look up a list of angel investors. There's some lists, but anyone who's on a list gets so many emails, they're probably useless. So where do you go and find them? Well, of course, there's always friends, family. You might be embarrassed. Maybe you're going to lose some money if it doesn't work. So you might want to look further afield. And here my advice is just post on LinkedIn, on Twitter. Be completely shameless. You can make a nice post. Not so much that you are just fundraising, but hey, I'm working on a new startup or whatever, solving this problem, a nice lifestyle image, and I'm looking to raise a few $100K, whatever it might be. Let me know if you'd like to learn more. And of course, you may find many people don't do anything, but you may get interesting responses. Some might go, yes, I'm interested in investing, tell me more. You might find partners. You might find friends telling you about competitors that you didn't know about. And you might find people telling you all sorts of feedback and ideas. So I think the idea as a founder, people sometimes think, I need to keep it secret, don't tell anyone. But you want to spread the news as widely as possible, so the more you network, the more you'll find, starting from an event like today or others. But on SeedLegals, we're about to launch the pitch feature in France. We've got it in the UK. People have made thousands of pitches. So you can make a video and you can put it on your SeedLegals pitch page. You can put a slide deck. You can put how much you're looking to raise, and then you can share that on social media with some nice reason, to get people excited, not just I want money, but you're going to tell them about the interesting thing you're doing. And you can try it. I mean, it's free, costs $0. And you never know when you'll get interest. And then you can use something like the BSA Air to go, oh, great, you're interested in investing 20K. Let me create a document for you for that. And now you use that as your initial so-called bootstrapping to get started. And then you look to raise more. And then you go and find VCs later on.
And when you find these angel investors, then you do the pitch. You mentioned, and you're right, we're launching the pitch features in France, but then it would be, okay, how can you build this pitch? Do you have like some recommendations on how to structure your pitch? Do you have like pitch decks you're working on? Who have pitch decks? Can you raise the hand? That's good. So maybe to give some advice to people here, like on the pitch decks, so yeah.
So I like the art of the pitch, So I'm sure any investor sees many, many terrible pitches. And pitches are once upon a time you'd go to the investor's office and pitch physically. These days it's often a Zoom pitch, but maybe it'll come back to physical. How many of yours are Zoom or in person?
100% Zoom.
100% Zoom, all right, okay. So the thing to note often with the pitch is you're not going to convince the investor on that call to write a check. Your goal often is to get them to be interested further. So you might want to, the first thing on a Zoom call is make sure that as you screen share, it goes full screen. You're not fumbling trying to find where the screen share is, because the person's going, if you can't screen share on Zoom, I'm not sure you're going to change the world. So, but the perfect pitch, and you can then tell me, for a pitch deck is, what's the big problem I'm solving? A new way to do X. How am I solving it? A very quick summary so that people understand what it is. It's not vaporware. Then maybe further details. Then there's who's the competition. Then there's what's the size of the market. Then there may be the traction, how far am I? There might be the 5-year plan. And then there's the team. And then there's what we want. And always end with a slide going, what we want. Otherwise people go, this is very nice. Thanks for sharing this. Why are we here again? So now raising 100,000 euro, whatever it is, and your contact address. And then you think that the slide deck, you might have a version that's designed where you're doing a presentation verbally, and the slides are behind you in the background. And then you can have big graphics with just a few words on it, because you want people to focus on what you're talking about. But there might be a variant which is not accompanied by you talking, and then it might need to have much more information on it. And then lastly, when you are doing a pitch, sometimes you'll be doing a pitch at a stand-up event and you've got 3 minutes. And when you're doing the 3-minute pitch, you need to practice. So it's literally 3 minutes. You're not spending the first half going, well, I had this idea. It's like people going. So memorize. The 3-minute pitch is all about the big idea, the traction, the team, what we want, done, job done. And I think then that ticks the box of the investor seeing you fixated, you know what you want. These are the goals to get to. This is the big idea. And this is what you want.
Would you like to add something, Alexis, on this, on the pitch? Because you see thousands and thousands of pitches, and so maybe before we go to the pitch, what would be the first the best catchphrase you received on an email, from a founders, or something the trick to, of course.
I will never tell you this.
Yeah. Invent something.
No, it's it's to stand out of a line.
Yeah, exactly.
Out of
we
receive a lot of emails.
How many emails do we receive with your team?
I don't count, but
yeah.
We reply to the ones that stand out from the mass. But that's all.
Okay, and what it is the trick with that is
improvise.
Okay, improvise. So no secrets for you guys. Sorry, but yeah, and for the pitch. So, is there any anything you'd like to add on what Anthony said?
It's super true. The thing with the pitch is that VC all VCs have a huge attention deficit disorder by seeing the pitch.
Otherwise, they'd be founders.
Yeah, exactly. And so the reality is that they can spend they need to understand the pitch and to understand the story by just spending 3 seconds on every slide. If they spend more than 3 seconds on each slide, they sleep. They have a huge problem with the attention deficit. And when I was a founder, I made super complex slides. My pitch was horrible, and because it was my passion. I was always breathing my startup, and I wanted to tell the world all the small little details and stuff like this. Because in my mind, in the mind of a founder, you think in graphs of ideas, and you need to linearize your thinking super efficiently with a few slides, few big titles that you can understand. Pim, pim, pim. A VC spends his time in the deck next, 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 next. And exactly what you said, in the pitch deck, there is 2 sections. The first section is how you excite the reader. How you exactly when you see a pilot of a TV show, the first episode, they bring you into this world. You bring the VC into your world by the problem, the solution, and stuff like this. And then when I'm excited, I'm that's a cool idea. And I'm yeah, what's the market size? What's the competition? And your second part is about answering the question in the mind of the VC. And that's what we see.
And then the call to action.
Exactly what you said, actually.
But then the call to action at the end, yeah.
Exactly.
How much you like to raise? But yeah, Anthony?
Now we had a question just here from the gentleman second row who's writing.
You had a question?
Yeah.
It was a quick one on. I don't think they're working actually.
Yeah,
They are? Okay, great.
for the video, not for us.
Okay, no worries. Yeah, it was a quick question on the discussion you just had about standing out of the crowd when we try to get your attention. Mailing is actually the only way to reach to you, at least at Kima. Maybe it's something that I should know, but I don't. Is it the only way to reach to you? Is it the only way we can? I don't know. No, it's not. It's not for me. It's for someone.
No, actually, yes.
Okay, so
yes, for one reason that LinkedIn messaging is it works only mostly at VCs. It works mostly on analysts, because analysts they reach out on LinkedIn people, so their inbox on LinkedIn they use it. Other people in VC funds they don't really read their LinkedIn messaging inbox, and it's actually a very shitty product. And then some people write on Twitter. The problem is that there is a lot of inbox, a lot of messages, and actually email is the best way to reach out. I don't know what you think.
Yeah, you can try whatever it works. If the person's following you happens to be following you on Twitter, you can DM them and so on. You can @ them, whatever it takes to get attention. So a couple of top tips from me. Another question? All right.
So I have a couple of questions. The first one is, what do VCs or the angel investor expect from the founder apart from the profit? Apart from the profit from the company. And second question, how we can negotiate, or how for me, I don't know how to make equity. How much equity should I give for them? How can negotiate? So how we can take the decision between the equity and the funding we are getting from them? It is always challenging for the young people like me.
Great question. So firstly, you mentioned profit. I don't think VCs or investors are looking for profit. They're looking for return on investment. But yeah. Well, so the first important thing is to understand that VCs and angel investors are often looking for very different things. So when you go to a VC raises a lot of money, 100 million euros, and they now invest in some number of companies. And some are exceptional, but in many cases they'll invest in maybe 20 companies. And they're looking for each company to what they call return the fund. So they're looking for each investment to be a unicorn, because they know they're going to lose on many others. And the problem with this approach is it leads to a very high-risk, high-growth strategy where the investor will give you large amounts of money and expect you to spend lots of money, but then you're on this treadmill, and if you can't raise more and you've got a big burn rate, then it's a big disaster. And you see that now with fundraising in a downturn, which we'll get to shortly. If you're on this treadmill, it's a real problem. But angel investors are a little different. So the VC might go, I'd like a 10% chance that you'll return 50 times my investment. That's great. But an angel investor is only doing a few investments a year. They don't want a 10% chance of 50x. They want like a 50% chance of a 3x investment. That would be good, because the bank will give them 0 interest. So angel investors are often likely to buy into things that don't have to be unicorns. And when you go to a VC, they might sometimes go, your market size is too small. It's like, our market size is 18 billion. No, it's too small. It needs to be at least $1 trillion before we're interested. So, it's not quite the question about profit, but it's the return on investment that different companies are looking for. Do you want to take some of that? What was part 2 of the question? Remind me.
Second part is, how can we decide?
How much to give?
Good point.
To investors.
This is my favorite pet subject. So what's the valuation and how much should you raise? So when you want to, of course, when you go to VC, the percent equity in your business that you are selling is a function of the amount you want to raise and the valuation. So how do you pick a valuation? And also how much to raise? So the first thing is you might read TechCrunch, and then you have to take at least 1 0 off the end, because those are crazy American valuations. You might also ask your accountant, what's the valuation? And they'll say, are you making money? And you go, no. Are you losing money? Oh, yes. Do you have any users, revenue? You go, no. They'll go, why is your value more than 0? So asking an accountant is useless, because an accountant values you based on your last year financials, but an investor is going to value you based on your future return. So the next thing is you can read sifted.eu or other publications that show how much companies have raised, which is great, but they never tell you what the valuation is, so that's not useful. The next thing you can do and you're going to get to the answer in a moment, is that you can use a spreadsheet to model your future revenue, your 5-year plan. So you go, in year 1, I'll have 0 revenue. In year 2, I'll have €1 million. In year 3, I'll have €4 million. And then you can work out from that, calculation on what the valuation might be today and in the future. But the problem is every smart investor knows that these are just bullshit numbers. You made them up. And the data that you get out is no better than the data you put in. And I sometimes see, and I'm sure you've seen, companies that in 5 years are claim to do €100 million a year in revenue. It's like, that's great. It would be fantastic. It's faster than Twitter was growing, and statistically unlikely. So what to do? So on SeedLegals, over thousands of rounds, we've seen that founders typically sell 15% equity in a funding round. And I'll turn to you in a minute to see if that matches what you see. So that means there's a common pattern, which means in the UK, which might be a little different, the UK has a special tax scheme which investors can deduct 50% of their investment from their tax up to certain levels. And the pattern it leads to is companies, firstly, maybe doing a founders put a median of 30,000 euros of their own money into the business before the first funding round. Because no one invests on a PowerPoint, you have to get something. So that's the data that we see. And then companies might raise 50 to 100,000 euros from friends and family. And then they may raise 200,000 or 300,000 euros from angel investors. And then they may raise 500,000 to €1 million from early stage funds, and then they have a Series A beyond that. And you don't need to do each of those stages, but those generally map. And what we see is that each time, founders would typically sell 15% of the business. And this might mean if you're raising 200,000 euros, you would multiply that by 5 to mean a valuation of €1 million, such at the end of the round, the investors own 200,000 out of 1.2 million, 16%. And so there's your formula. So now, if you see, you might raise 200,000 initially, and then $1 million afterwards, and then several million later. And if you dilute 15% over 3 rounds, and you have a 10% option pool to give share options to your team, at the end of 3 rounds, the founders still have more than 50% of the shares, which is great. And then maybe you think after 3 rounds, we'll have an exit, and everyone benefits. How does that match what you see and you suggest?
Yeah, that matches perfectly. So the standard we see right now in France is 15%, exactly 50% dilution for the round. So your whole round is 50%. And especially there is no VC. When there is a VC involved, usually it's between 20-25. And but when there is no angels, it's mostly 15. The reason, I don't know. I just did. It's just like we just took the stats and we made a calculation, and it's this. It's just a correlation. I don't know why.
It's maybe because of the amount. Because when you raise, usually with also like with some VC at Series Seed, for instance, usually the amount is like close, as you said, Anthony, like to $500,000 or $1 million. Maybe when you like raise with some business angels, it's not like a rule. This is what we also see with business angels. Usually, it's like, as you said, again, like 50 to 100,000. Maybe there is a correlation between the amount and the percentage dilution, but then, as you said, it's just also like a discussion, negotiation with valuation, and when you like to avoid this kind of discussion, as we said, also with agile fundings, and also it's not only with valuation, but with all the rest, as you mentioned, Alexis, with the shareholder agreement. So you don't discuss the, like if you do a board, if you create a board, if you have the governance, so with decisions to get the approval from the board to take this decision and so on. So you do what? You do the BSIR. So you don't fix the valuation, but how you will like convince an investor to do a BSIR rather than just an equity pricing round? Do you have like maybe some example?
The reality of a BSIR is that theoretically you don't fix the valuation in advance, but in practice the valuation is exactly equal the cap. And so you technically you've set the valuation even if in the contract it's not set, and so it's just a legal way to close faster. It's a legal way to close faster and a better selling product to do agile funding, what you described. But for me, like for every business angels or for every investor that can invest in BSR, like the BSR is a better tool for everyone.
That's super clear.
It's quicker for investors. It's quicker for investors.
Even faster. Exactly, with SeedLegals and the platform, so that's pretty cool. But you'd like to add something, Anthony?
Yeah, so the question, by the way, why 15% dilution for angels and more for VCs? I think there are a few reasons. So when you're an angel investor, you're normally investing a small amount, and you might be getting 1% equity. So if it's 1% or 0.9%, it's the same to you. But when you're a VC, your 15 or 20% equity buys you a board seat and certain consent rights. And what the VC often wants is they want to have a certain level of control in the company. They might be investing a big amount, and that comes with some control. And they want their control to be significant, and therefore they need a significant amount of equity, such that even if they get diluted in the next round, they still have that amount. Also, angel investors are often coming in earlier, and they're investing based on you and the hope and the dream, whereas the VC often comes in later and invests on a multiple of financials and will drive a bargain on the valuation to get more equity. So often going to angel investors is much more advantageous for you because they'll get ordinary shares, they won't get a board seat, they won't have investor consent requirements and management reports. But of course, at some point, you need so many angel investors to fill your round that you need to go to a VC. So angels first, VCs later.
And we started this event with the context. So maybe we can go to the context because we had a super well prepared, not this slide with us, but not this summary we didn't follow at all, but with this one. So this one is about this context because you've heard about, okay, there is a crisis, there is uncertainty in the air, okay, funds will stop to invest, so okay, you need maybe to raise now, or should you raise now? But we will come to that just in a moment. But first, it will be with this picture. Maybe as you can see here, it's like 2021 VC language. Okay, I follow you. Okay, whatever the valuation price, I follow you. Okay, your price is my price, and so on. So NFT, that's great. Web3, okay. Amazing, I follow you again, even better and higher valuation. But then what we see here, 2022 VC language will be, okay, no, valuation is really important, so we will negotiate, we will discuss based on your data and so on. So my point here with this slide is also to finish with the YC. Maybe you've seen this YC email sent to the portfolio of their founders. It's about, okay, you should be careful with the burn of the fundings, so your runway, etc. So my point here is what is happening here in 2022. We're on May, so do really VC stop to invest? Either any some specific stuff we have to know about high valuation with high growth companies in the US going down in the public market and so on. So do you have any tips or anything to share with us, Alexis, first maybe to begin?
So it's pretty funny. No, it's not funny at all actually. But but the reality is that the central bank printed a lot of money, especially during. So since 2008, a lot of measures in the macro level has been put in place, especially the quantitative easing. And so all this printing of money starting after the great financial crisis in 2008-2009. A lot of money has been diverted to the market, and we are used to be pumped with money from central banks since 2009. And the reality is that after COVID, during COVID, these central banks printed a lot more money and flooded the market with money. And the reality is that for one reason, it was exactly to avoid people losing their jobs. It was to sustain the economy, to put the economy in perfusion in order to make the economy work again and not to be disturbed by the lockdowns. It worked really well, to be honest. And it depends on the point of view, but but he did his job. And the thing is that this money went a lot in the disturbed the market and went a lot into equities, and you can see the curves in the S&P 500. The reality is that after a while, that inflation started to pick up again with the Ukrainian war and a lot of different factors, and with inflation, the central banks raised the interest rate and stopped this process. And actually, it's actually the COVID money that has been printed. A lot of people enjoyed from this, and then it has been stopped because it's the end of COVID for the central banks, and that's normal that it gets back to the level that was normal, and that's what we saw in the in the public stock market right now. That exactly the end is that on the public stock market, the companies are usually for the SaaS business are valued into multiple of annual revenue, in multiple of ARR. And it's true that some SaaS businesses were valued in the public stock market at 100x, 100 times the annual recurring revenue. And right now it's more than 5. The reality is that when you're investors, you want to exit your company. You want to IPO someday. So it affects all the chain of capital. So all the growth, the investors at Series B, Series C, just before the IPO, they say, okay, so right now I cannot IPO the company at 200x the revenue. It will be more 5x. So it changes the valuation. Then the Series A investor says, I need to be tighter in valuation. It impacts the chain. And it took between December, January, February, and right now to impact all the chain. And that's actually true. In Q4, it was absolutely crazy. There was so many money in the VC market, and so many people, a lot of VCs as Tiger and Co, and were flooded the money with that they were doing a lot of crazy up rounds and a lot of crazy Series A, Series B, Series C, because they were basically term sheet generators. And the reality is that a lot of seed funds were like, okay, NFTs, let's send a term sheet, because the reality is that they know, we'll give it to Tiger after. And it inflated the sense of risk, reduced for a lot of investors. A lot of founders thought that the risk was more or less zero to start a startup, and started a startup for the wrong reason. And sadly, and that's actually the people that will suffer the most, to be honest. And Q4 was crazy. There was some startups, I could see them only in 30 minutes, and I need to make my decision in 30 minutes. There was some people that was refusing to do customer due diligence for Series A, or even for large seeds. And it was completely crazy. Like NFTs, I had a discussion with a VC about a super solid Web3 startup. They told me, do we believe in crypto? Was like, did you not have a .if domain on your Twitter Twitter page 8 months before? It actually came back to right now to a new normality. There is still funding. VCs have a lot of dry powder. They raise a lot of money. They have money to invest. It's just is a little bit more normal. It's a little bit like what we had in 2019 before the COVID bubble.
So it's a good point and a good correction we can expect from the market, and this is what you say. So it's a good thing. So what to say about this email, Anthony, and YC Combinator? So what in the US, all the super.
Yeah. So my take is, so far I'm not seeing it changing anything significant in the UK or in France, and so really the European VC market is always calculated valuation, maybe based on an 8 times or something multiple of your company's revenue in the later stages once you've got revenue. In the US, there was a perturbation for a year or two where it went mental to 10x that amount, and that's just corrected itself. So I think the crazy Americans created a bubble, and now the bubble's deflated. But the Europeans never had the bubble, and so there's no difference. Now, it's so to my take is that for now there's not a substantial difference, but 2 things may be different. Number one, if you're an investor, you might now be focused on companies that are more likely to be revenue generating and not loss making forever. So if you're the crazy NFT, maybe when the bank was paying me 0% interest, I take a bet on something because I'm getting 0 from the bank. But if the bank's paying me interest, or I have to pay interest on borrowing money, I want a more reliable return on investment. So I think we'll see a move of investment to businesses that you can show will be revenue generating, rather than ones that will just eat more and more investment with a hype, unless you're seriously good at your pitch. And what was the other one, which was, I think that was the main one.
And maybe if you can raise now, will you do it, or like will you maybe wait? So this is like maybe a stupid question, but like if you're keen to raise some funds, should you do right now because of the context, or maybe if you like wait a bit, you think maybe your product will be better, getting more traction, so you can wait. But maybe some founders would say, okay, maybe because I hear a lot of like I should raise now because there is no money afterwards, so should I do it right now, or should I do it maybe later, based on what I said?
So, if you're like SeedLegals, we have revenue, we have money from our last raise, we can choose. We can raise the money now, or we can raise in some time in the future, and it's a decision to make. But if you're in the room, you've only got, either you're spending your own money, a few thousand euros each month on your company, and that limits the rate of growth. You can't hire several developers, and so you have to either raise or it stays on the slow burn. So it's really not so much an option. If the only thing standing, the time to raise investment is when the rate at which you can grow your business is limited by the amount you can fund it yourself, and you think it makes sense to take it to the next step. So it's really when it moves from a hobby or what you can afford to pay yourself. And if you go next month, my traction will be less because I cannot hire this developer or this designer. That is and I see there's traction. That's a good cue that you should fundraise. But on the flip side, if you're going, well, we're still working on what it is, and I'm paying almost nothing each month, I'm paying myself, I've got a day job, there's no imperative to raise, and you'll get there when you get there. But I don't think the fundamentals in the market change it, because, one thing as a founder is you have to make decisions. Failure to make decisions is death. Nothing happens. So, and the other thing is, if you want an outcome, these things take time. You may as well start now, otherwise it just sits around forever and you'll be annoyed with yourself a year later where your fantastic idea, you just seen someone else launch it and you didn't. So you can be sure if it's a good idea, if you're not building it, someone else is. And that means you want to get focused as soon as you are suitably sure that it's a good idea. So read the MOM test, a great book to validate that it's a good idea, before you give up everything on some crazy idea. Do suitable validation. But once you've got to that point, then with like military precision, you want to see what are the steps to get to that end game. And then you're going to convince your investor that you're following these steps, that the investor will want to be excited and be part of the journey.
Yeah, I agree. Actually, the Remark for the Test is the best book you should read at early stage. Really, I really mean it. If I have read the MEM test, I might not be here today, and my startup would have worked. To be honest, I did most of my mistakes were made because I didn't read the MEM test, and I was stupid because I had the MEM test at the time. I purchased it on Amazon, but I didn't read it. The
name of the book?
The MEM test.
The MEM test.
Yeah.
MOM, M-O-M, it's like 10 euros or whatever on Amazon. And the reason it's called the MOM test is that, of course, you have this idea and then you go out and you ask people, is it a good idea? And you ask your mother, I'm doing this blockchain-enabled GPS, Wi-Fi access bicycle lock. Isn't it, it'll find your bike anywhere, isn't it a great idea? And your mother goes, I've no idea what you're talking about, but my son is such a clever boy, of course it's a good idea. But you're asking the wrong question to the wrong audience, and of course they're going to tell you it's fantastic. And instead what you should find are people who actually might use what you've got, and then you shouldn't ask them, isn't it awesome if, you should ask, have you ever looked for one of these before? How much have you paid for it? Did it work? And if someone's never looked for it before, either you've got a groundbreaking new idea, or quite possibly it's a vanity idea. No one actually is looking for it. And to realize that before you've raised investor money and spent a year on it is much better. And then, of course, ask the real audience who actually would look for that. And you might even find the real audience by buying Google keywords as if the product existed in the kind of fake it till you make it. You know, advertise it almost on Google with some pay-per-click advertising. It'll cost you a few euros per click. You don't need too many to find out, are people clicking on it? There's 0 people clicking on my ad. Even if I built the product, I couldn't sell it. So, and then you might refine your landing page and your wording. And once you see that there's an idea that people are going for, only then do you build it.
So maybe to finish, because we run out of time, just with this slide to complete what we just heard from the speakers, is like the numbers of deals we had on SeedLegals this year so far, and we shared that on the Sifted article with you, Anthony, commented this. So it's still going on with funding, as we heard also with Alexis. So maybe it's time to go to the Q&A. So do you have any questions? First question. Yeah.
This question is for you, Alexis, because I was wondering, does investment firms, VCs or angel investors only invest in really high scalable businesses like SaaS services, or they can still finance some more basic projects, you know, or are they only interested in high scalable business?
The reason, so the quick answer is yes. They can invest more or less only in very scalable business. And it's because it's actually how you get the valuation from. All this high valuation we see from VCs, it came because, and the history of VCs came after the Genentech. So it started with pharmaceutical, with Genentech in the year 1980s, and then it's 1970s, I think, Genentech, I don't remember. And then it really started with software and computer and the reality is that the copy cost of software, the cost of copy of software is 0. So when you build software, it's super scalable because you can distribute it to a lot of people. You manufacture it one, it costs 0 to copy, and that's how a lot of VC models are based. And then it became a little bit more complex with SaaS because you have customer acquisition costs, you have some sales team and stuff like this. And that's the reason why. SaaS startup is valued even at 5x the revenue, the annual revenue, or 100x depending on the time of the market. And when you see, for instance, I think a bakery or a pizza shop is 2x the revenue, and so it's not really. I think it's the multiple for a pizza shop, and so it's the reality is that their model of investment doesn't really fit this. And if you manage to make it some way, you have a VC investing in your pizza shop, and the problem is that you will get screwed because you will set up a board, and then they understood at some point that where they cannot give, if they are investors, they need to give a hot potato to a Series A investor, they cannot do it, and so they are screwed and they will be super annoying to you. You cannot distribute dividends anymore, they will be super earning, and it's a bad thing for entrepreneurs. And usually, even for tech businesses, software businesses that are not super highly scalable, it's actually a bad financing strategy for startups, for entrepreneurs, because they will lose much more money because they cannot distribute dividends anymore.
So you better go to traditional way to fund your company, like banks or other thing.
Or business angels.
Or business.
Business angel works because the business angel can accept these risk profiles, can accept dividends, and or if you build, for instance, you have the case. So we discuss a lot about SaaS with high growth, but you can build software startups that are not that scalable, that is nice businesses, and that makes a lot of money, but it's not going to be a unicorn. And then you can make enough money to repurchase the business angel sometimes.
Do we have other questions? Yes.
Does SeedLegals support companies that are just based out of the EU or also out of North America?
Tell from the accent where you're from. So right now it's UK, France, Ireland, Singapore, and Hong Kong. We're not US as yet. We'll get there one of these days. By the way, just on the the multiples and the fundraising, one of the things you'll see from VCs, and the reason a VC will say no or won't tell you why, is if they sniff test that it feels like a time and material business. So time and material business is maybe where you're charging for your time and services, and companies, they're big companies and make a lot of money, or you personally might be charging your services as a consultant, and it's a great lifestyle. It might be tremendously profitable. But for a VC, there's no scalability. You're not going to be 10x the multiple in a few years. You can hire more people to work with you, and they'll all be making a nice living. So for you, it's a nice living, but a VC will call it a hobby business. It's for you, it's the hobby, but for them, it's not an investment. So when you're showing your pitch deck to the VC, if you've got a pure play SaaS, we spend lots of money developing software and then millions of people use our software, that's the classic excited. But if it turns out you've got a big customer support team, or people are seeing that it's people plus some software, or there's hardware, then the formula is quite different. And then VCs, either the classical VC may not be interested, and you may need to go and find a strategic VC that knows a particular market segment, or angel investors. But ultimately, if you have a restaurant, how will your restaurant ever be worth 10x what it is today? If it's the same restaurant, it can't really be worth that much more. So fundraising for equity for a restaurant may never really be sensible unless your goal is to create a franchise and 50 restaurants and so on.
Maybe one last question. Okay, maybe two last questions. No? Yeah. There you go.
Thank you so much for the presentation. I got so many replies that I just thought from the beginning. So actually, my name is Jan. I'm CEO of Biscoats. We try to help kids to find their passions with our solution of online platform, and we are now actually fundraising. So that's why we are here. We are early stage. We just started some months ago, but we already have tractions. So, and we already had a meeting with Baptiste of Kima Ventures, but actually he told us that, oh, I'm very interested in you, but please come back later. So that's why we are here to come back later. After some weeks of later after the meeting with the Baptiste. And actually, when you were talking about the market size, that was my question, because we are now working on our pitch deck every week. I think it's the same for you all, because we are completely changing our strategy every week to make better pitch deck every week. And the market size was one of my question. What is the big enough market size for the VC or for the investors or business angels? Because actually education market is sometimes quite small compared to the NFT market or whatever, because it's a conventional sector. So I wanted to know what is the big enough market size that the VC can be interested in. Thank you.
So this question about market size is super interesting, because for a while I was thinking that when I was an entrepreneur and in my first years at Kima Ventures, I was telling all VCs that they were super annoying to us founders to have like $1 billion market size, because reality is that €100 million market size is fine. If you capture all the market size, it's like 100 million ARR. It's a huge company. Tell me about your company portfolio that is at 100 million ARR. And then I realized 3 to 4 years ago that the reason why they ask for big market size is because of there is something known the chasm. You can find on the Google Images. You will type crossing the chasm, crossing the chasm, 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 and I have a super horrible. I lived in London for 2 years. I have a horrible English accent, so crossing when you see the picture of crossing the chasm, you will see that you will have in every market, when you sell, you will first sell to innovator, then to early adopters. Then you will have a chasm that is super hard to cross before the early majority. Each of these steps is a percentage of the market size. So the reality is that you want to go until your Series A with the innovators plus early adopters. And then after your Series A or after your Series B, you will cross the chasm, and it will be the tough part to go to the majority. And that's why you raise a lot of money to cross this chasm. So if your market size is too small, you will not be able to reach the revenue that is required for investors for a Series A. Usually for a seed round with VCs, it's around 10k of MRR for monthly recurring revenue. For a Series A, it's between 80 and 100. And if your market size is too small, so you can use this as a framework. You type crossing the chasm on Google Image, you will see there is one picture with percentage on the bottom, and you can use this as a. Usually it's around 1 billion. Which I could have started with this, it would be simpler. Or usually it's approximately 1 billion, and then it depends from the investor to investor. Sometimes it's 1 billion in France, sometimes 1 billion in the EU, mostly 1 billion in France if you can manage to do it. But it's not.
My take is those market sizes are often completely made up. I mean, if you put it was 18 trillion or 1 trillion, no one's going to know. But to me, it's a kind of a test of the numeracy of the founder and the level of ambition. So if their numbers clearly don't make sense, I'm going to question everything afterwards. If the numbers are too modest, so you want to do bike rental but just in the Marais district, okay, great. It's very nice, but it's not an investment because it's too small. So you want to show the investor your level of ambition that stops short of being crazy and is plausible, and also how you've thought through, the TAM, SAM, and SOM, the total addressable market, the service addressable, and then what you can reach initially. And then the investor sees that you're thinking through the problem in a way a founder would. And actually, I think that's one of the kind of the key that the investor isn't sure about, which is, I think, the investor's sort of internal AI human intelligence is doing a pattern match. Does this look like a successful founder? And a successful founder is focused on these things. And if you can look like the successful founder, learn, TAM, SAM, SOM, and the other things, and show that you focused on these as part of growing your business, that increases the investability. Now the man in the...
One last question. I'm curious. Can you share real-life data about how many seed angels are investing without the exit or the equity round? Because only 1% of startups have VC equity rounds following that. So what happens with the early stage investors being angels? How do they exit, or how much money do they get from dividends or other means?
Great question.
In other words, how do you sell to early stage angels? What is their perspective?
Right. So obviously you are selling the promise without crossing over into deceit of the future potential. I'm not sure that it's 1% raise VC investment. I think it's a lot higher than that. So companies might exit by selling the company. You might close the company. You might keep raising. You might raise a few times and then actually don't need VC investment because the company is now making sufficient revenue and everyone's happy. And actually it could be one of an odd situation that the founders and the team are delighted. The company's profitable. They're paying themselves salaries. But the investors are unhappy because there's no new funding round and no exit. It's a static. But in the UK, it's a little different because there are generous tax incentives for angel investors that dramatically reduce their risk. But here you want to help investors understand without promising an exit, because you can't, it's not in your gift to promise an exit, and you'll make everyone very unhappy if you go, I promise an exit in 3 years at a 10x multiple, because when 3 years come and you're nowhere near that, there's someone will refer to the email or whatever it is that you promised it. So you want to try to, and I don't have the numbers, but I think we should actually be on point to find some of these numbers, or maybe you've got them, but a great number of companies raise the first round, a smaller number do the next round, a small number. The investor is going to understand that the chance of success is not 100%, maybe it's 30%, but if they get a 10x return, those are the numbers that they're playing with. And I think any astute angel investor realizes that if they wanted to be a bank, they would lend money for 8% with a 99% chance of return, and otherwise they're going to invest. I think the other interesting thing is investors are often not only investing for return on investment. In fact, there are many angel investors who might invest for completely other reasons. And I've done an article on what type of angel investor are you. So it might be, I want to change the world, the oceans, plastic, children in Africa, whatever. I know there's going to be no return on investment, but I want to help, is number one. Number two, I want to hang out with the cool kids. So I want to tell my friends that I was the first into whatever, blah, blah car, whatever, and so they want to pick potentially hype-worthy ones and write a first check, and they'll take a risk. Some are wannabe founders themselves, and these are the dangerous ones. So they go, I'll help you, I'll come to your meetings, I'll help with design, I will offer advice. In fact, I insist on offering advice. And at some point you go, this is my mother, I didn't need that, I want an investor. So and others will be the spreadsheet guru, and they'll model your 5-year business plan and work out a multiple and see if they're in or not. So one of the key things is when you go to an investor for a presentation, try to work out and do your homework beforehand. What does success look like for them? It might be a high net worth individual where the 20,000 euros is nothing for them, and what's in it for them is like playing a game of poker. There's a return, but unlike the game of poker, they can do good for the world, and they can see the money going into something valuable. And actually, if they've got a plausible return on investment, they're happy. Or maybe that they're doing events and you'll bring them with others. There are endless numbers. So work out what you think to the extent you know before you meet with them. And then when you're talking to them, analyze from their questions what's the driver, and then tweak your presentation to play to that. So if you can see the person's focus on the numbers, focus on the numbers. If you see the person's focus on how it's going to benefit humanity, keep playing to that, because your goal is by the end of it to get them either to go, can I send you a term sheet or a BSR, or can we follow up with the next call, and what would you like to take you to the next step?
Thank you. Thank you, Anthony. Thank you, Alexis. Thank you all for coming by. Can give a big round of applause.